Listen up, beginners. If you're just starting out in the world of investing, this is for you. Want to make some serious money in the stock market? Of course you do. Who doesn't dream of financial freedom and the ability to grow their wealth exponentially? Then you need to learn how to spot breakout stocks. These are the stocks that have the potential to skyrocket in value, giving you significant returns on your investment. These are the rockets ready to launch, and you want to be strapped in before they take off. Imagine catching a ride on a stock just before it shoots up in value. Identifying these winners before everyone else is like having a crystal ball. It's like peering into the future and seeing which stocks are about to make a big move. It gives you a huge edge. Being ahead of the curve means you can capitalize on opportunities before the masses catch on. Breakout stocks are those that are poised for explosive growth. They have all the right conditions to surge in value, and recognizing them can be a game changer. They've been quietly building momentum, and then bam! They suddenly take off, leaving those who weren't paying attention in the dust. They take off like a shot, and if you're on board, you can ride that wave to substantial profits. But how can you tell which stocks are about to break out? It might seem like a daunting task, but with the right knowledge and tools, it's entirely possible. That's what we're here to find out. We're going to dive deep into the strategies and indicators that can help you identify these breakout stocks. Don't worry, it's not as complicated as you might think. With a bit of guidance and practice, you'll be able to spot these opportunities with confidence. With the right tools and strategies, anyone can learn to identify these potential winners. It's all about knowing what to look for and how to interpret the data. We're going to break it down into simple, actionable steps that you can use right away. No jargon, no complex theories, just practical advice you can implement today. Get ready to level up your stock picking game. By the end of this, you'll be equipped with the knowledge to make smarter, more profitable investment decisions. First up, let's talk about the Relative Strength Index, or RSI. This handy little indicator tells you how overbought or oversold a stock is. Think of it like a thermometer for the market. A high RSI, usually above 70, suggests a stock is overbought. It might be due for a pullback, but that's not our focus today. We want to see stocks with an RSI above 80. This indicates extreme momentum. It's like the stock is on fire. To find these scorching stocks, you can use a stock screener. This tool lets you filter stocks based on certain criteria like RSI. Set your screener to show stocks with an RSI above 80, and you'll have a list of potential breakout candidates. Now, let's talk about volume. Volume is one of the most critical aspects of trading that often goes unnoticed by beginners. It's not just about the price movement. Understanding volume can give you insights into the strength and sustainability of a trend. Volume is simply the number of shares traded in a stock, but don't let its simplicity fool you. It holds a wealth of information about market sentiment and potential future movements. It's a crucial indicator of market activity and interest. When you see high volume, it means there's a lot of attention on that stock, which can be a signal of significant news or events. High volume means lots of people are buying and selling. This can lead to more volatile price movements, which can be both an opportunity and a risk for traders. Low volume? Not so much. Low volume can indicate a lack of interest or uncertainty about the stock, which often leads to more stable but less profitable price movements. Why is volume important? Because it shows you the force behind a stock's move. Think of it as the fuel that drives the price action. Without sufficient volume, price movements can be misleading. A stock might go up in price, but if it's on low volume, it's like a weak whisper. It might not have the strength to sustain that upward movement. A stock going up on high volume, that's a roaring crowd. It indicates strong interest and can be a sign that the trend will continue. A great tool to visualize volume is a custom study in Thinkorswim. This platform offers various ways to analyze volume, making it easier to spot trends and make informed decisions. This study paints candlesticks blue for high bullish volume and yellow for bearish volume. This color coding helps you quickly identify the type of volume driving the price action. Seeing a stock with a string of blue candles, that's a sign of strong buying pressure and potential breakout. Understanding these nuances can give you a significant edge in trading. Remember those stock screeners we talked about? They're not just for finding high RSI stocks.
You can use them to filter out the junk and focus on stocks that meet your specific criteria. One essential filter is volume. You don't want to waste your time on stocks with anemic trading activity. Set your screener to only show stocks with a minimum daily volume of, say, 500,000 shares. This ensures you're looking at stocks with enough liquidity and interest. Another helpful filter is price. You can set a minimum price to avoid penny stocks and focus on more established companies. Experiment with different filters to narrow down your search and find the best potential breakouts. Here's where things get exciting. We want to catch breakout stocks right as they're taking off, not after they've already skyrocketed. To do this, we need to identify the first significant move. Thinkorswim has a fantastic study for this. It compares the current bar's average volume to the previous bar's average volume. If the current bar's volume is significantly higher, say twice as much, it could signal the start of a major move. Imagine a stock has been quietly trading with average volume. Suddenly, bam! The volume spikes. This surge in buying pressure could be the catalyst for a big breakout. That's the wave we want to ride. Section 6. Green means go, the power of a positive start. Another bullish signal to look for is a green candlestick. A green candlestick means the stock closed higher than it opened. It's a visual representation of buying pressure and positive sentiment. Seeing a green candlestick alongside a surge in volume is a powerful combination. It tells us that buyers are in control and pushing the stock higher. It's like getting a green light to jump on board. Of course, a green candlestick alone isn't enough to confirm a breakout. But when combined with other indicators, it adds another layer of confirmation to our analysis. Section 7. RSI's rate of change measuring momentum's might. Remember how we talked about using RSI to spot overbought stocks? Well, we can take that a step further by looking at RSI's rate of change. This tells us how quickly the RSI is moving, which is a measure of momentum. A rapid increase in RSI, like a jump of 10 points or more in a day, suggests a sudden surge in buying pressure. It's like the stock is shifting gears and accelerating quickly. Thinkorswim allows you to set alerts for RSI changes. This way you can be notified instantly when a stock experiences a significant RSI jump, potentially signaling a breakout. Section 8. Riding high closing prices and market strength. Another sign of a strong stock is its closing price relative to its recent highs. A stock that consistently closes near its high is showing resilience and strength. It's like a marathon runner who's still full of energy at the finish line. Thinkorswim's highest function is a great tool for this. It lets you see the highest price a stock has reached within a specific period. If a stock is closing near its recent highs, it's a sign that buyers are still in control. This indicator helps us avoid stocks that might look good on the surface but are actually weakening. We want stocks that are finishing strong, not fading at the end of the day. Section 9. Percentage power quantifying stock movements. Finally, let's talk about percentage change. This is a fundamental concept in the world of stock trading and investing. Understanding how to calculate and interpret percentage changes can give you a significant edge in the market. This simple calculation tells you how much a stock's price has moved in percentage terms. It's a straightforward way to measure the performance of a stock over a specific period. It helps you compare the relative strength of different stocks. By looking at percentage changes, you can easily see which stocks are performing better than others, regardless of their actual price. The formula is simple. New price times 100. This formula can be applied to any stock, making it a versatile tool for traders and investors alike. For example, if a stock goes from $10 to $12, that's a 20% increase. This kind of movement can indicate a strong upward trend, which might be worth investigating further. By tracking percentage changes, you can quickly identify stocks that are making big moves. This can help you spot potential opportunities before they become widely known. A stock that's up 10% in a day is clearly outperforming one that's only up 1%. This kind of information is crucial for making informed trading decisions. This information can help you focus on the strongest potential breakouts. By zeroing in on stocks with significant percentage changes, you can better allocate your resources and maximize your returns. Remember, these strategies are just a starting point. The stock market is complex and ever-changing, so it's important to stay flexible and adapt your strategies as needed. The key is to combine them, experiment, and find what works best for you. Don't be afraid to try new approaches and learn from your experiences. So get out there, start practicing, and may your portfolio be filled with breakout winners. With dedication and the right strategies, you can achieve great success in the stock market.